This AI-generated podcast is for general information only and does not constitute financial or legal advice. Please consult a qualified professional. Welcome to the Luxembourg Fundcast. Produced by Bertrand Mariaux, a regulatory lawyer qualified as Avocat à la Cour in Luxembourg and Paris, this show brings you reliable insights on Luxembourg regulations sourced from curated official references. This episode is current as of 12 May 2026.
And it is great to be here. We have a really fascinating deep dive for you today.
We absolutely do. Today we are exploring the Luxembourg Lombard lending and financial collateral framework. I know that sounds quite technical, but it is effectively the operational foundation of cross-border private wealth management.
Right. It is the framework that dictates how secured credit lines actually function in practice.
Yeah.
Our mission today is to clarify how these liquid portfolios are used as collateral, and more importantly, why the rather practical detail of where a digital account is maintained is so crucial.
Yeah, and before we really get into the weeds, I think we should outline a few key takeaways for you from our sources. First, we'll see that account location governs almost everything. Second, having a legal agreement is one thing, but operational control over a digital account is, well, it's the true test.
Exactly. And the third takeaway would be that execution and alignment, specifically aligning your documents before any market stress occurs, is really the current focus for practitioners.
Right. So let's start with a very general overview. Think of a Lombard loan as a highly regulated, elegant form of secured lending. You, as a client, put up a diversified, highly liquid portfolio of securities like equities or bonds as collateral to secure a line of credit from a bank.
Yeah, and if a default occurs or if the portfolio's value drops significantly, the lender can legally take ownership of those assets to recover the funds.
But our official sources make it clear that the formal pledge agreement, the contract itself, is just the legal center. The operational lender is, well, it's control, isn't it?
It is entirely about control.
Yeah.
The lender needs a highly reliable mechanism to control the specific digital account where those securities are kept. Without that operational control, the legal contract is, quite difficult to enforce.
Which brings up a really interesting logistical issue. We are talking about digital book entries. They don't sit in a physical vault somewhere. So how do you actually put a physical lock on an entirely digital account?
Well, to understand that, we first have to look at where those assets legally reside. And that leads us directly to the foundational text here, which is the Luxembourg Financial Collateral Law of the 5th of August, 2005.
Okay, let's unpack that law. But before we look at the mechanics, there is a very specific nuance regarding the legal sources, right?
Yes, exactly. The Commission de Surveillance du Secteur Financier, the CSSF, often issues very helpful consolidated versions of these regulations. However, the CSSF explicitly reminds practitioners that only the texts published in the journal Issel, the Legilex, hold actual legal authority.
Right. So the regulator is essentially saying, don't just rely on our convenient summaries.
Precisely.
Mm-hmm.
In cross-border finance, there is simply no room for ambiguity. If a substantial credit facility is on the line, any slight error in a consolidated document could theoretically create complications. Lawyers must rely on the Legilex because it is the unassailable sovereign record.
Elegance and precision are key. And that precision helps solve what used to be a major hurdle, which is jurisdiction. Because if you have a borrower in London, a bank in Switzerland, and a custodian in New York, well, which country's laws apply if things go wrong?
Yeah, historically that was a highly complex issue. But the 2005 law resolved it with a very clear conflict rule. It establishes that for book entry financial instruments, the law of the country where the relevant account is maintained governs the arrangement.
Ah, so the domicile of the account itself is what matters.
Exactly. The account location dictates perfection, which is making the pledge enforceable against third parties, as well as priority of claims and the rules of enforcement.
So by situating that account in Luxembourg, you bring in the entirety of Luxembourg's highly reliable legal framework.
Right, regardless of where the lender or borrower are domiciled. But that still leaves your earlier question, how do you physically lock down a borderless digital asset?
Yeah, how does that actually work in practice?
Well, Luxembourg law offers 4 distinct methods to perfect a pledge. It bridges the gap by turning the contractual setup itself into that digital lock.
I really want to walk through these 4 methods because this is where the legal theory meets the IT architecture. What is the first method?
The first one is quite straightforward. The pledge is perfected by the pledge agreement itself, provided that the custodian holding the assets is also the pledgee.
Okay, so the lending bank already holds the client's custody account on its own systems.
Yes. Operationally, it is very seamless. But, clients often use multiple institutions. They might borrow from Bank A, but keep their assets at custodian Bank B, and that requires the second method, which is a control arrangement or a notified agreement. Basically, the lender, the custodian, and the client enter into a contract that legally binds the custodian to follow the lender's instructions regarding those assets.
That sounds like it requires a lot of coordination. Getting two separate financial institutions to agree on communication protocols and legal triggers, that has to be an operational challenge.
It definitely requires careful structuring. If the systems can't be aligned smoothly, they might use the third method, which is book entry registration, directly to the pledgee's account.
So you actually move the digital record of the assets out of the client's account and into a collateral account held by the lender.
Precisely. It provides excellent security for the lender, but it does restrict the client's ability to trade those assets easily, which is why the fourth method is very frequently used.
Let me guess, they leave the assets where they are.
Yes, exactly. It's perfection via a designation in the custodian's books. The assets stay in the client's account, but the custodian flags them in their internal IT system, clearly designating them as pledged collateral.
Wait, really? A digital tag in a database provides robust legal protection. How does a mere flag in a back-end system hold up?
Well, what's fascinating here is that under Luxembourg law, that specific digital flag carries substantial legal weight. The law essentially elevates an IT designation into a firm legal barrier.
So it legally separates the collateral from the rest of the estate if an insolvency occurs.
Exactly. Luxembourg's framework takes an operationally efficient database flag and gives it true legal solidity.
It's quite elegant when you think about it. It's like an operating system for international finance. But unlike static assets, the securities in these accounts are constantly fluctuating in value. How do regulators make sure the loan remains adequately secured over time?
That is where we transition from legal setup to rigorous credit risk discipline. The CSSF treats Lombard lending as a dynamic, ongoing life cycle.
Right, because a perfect legal lock doesn't help if the assets inside suddenly lose their value.
Exactly. The CSSF expects this life cycle to involve highly transparent loan documentation and, importantly, the application of prudent haircuts.
Let's define a haircut for a moment. If you're borrowing against a portfolio worth 100 million euros, the bank won't lend you the full amount. They apply haircuts, say, 30%, and lend you 70 million euros.
Yes, and that 30 million euro buffer exists so that if market values drop, the loan remains fully covered. But crucially, the CSSF requires those haircuts to be actively monitored.
Because the risk profile can change, right? Even if the total value stays the same.
Exactly. If a client sells stable bonds and buys highly volatile equities within the pledged account, the early warning systems have to detect that shift in concentration and volatility immediately.
That implies a very significant operational burden for the bank, monitoring the value and concentration of thousands of assets in real time. The IT infrastructure must be quite sophisticated.
It is a highly advanced operational requirement. The CSSF specifically expects the capability for timely corrective measures, having the legal right to issue a margin call.
Which is asking the client to deposit more collateral.
Right. Having that right is meaningless if your systems take 3 days to calculate a shortfall.
Because if the portfolio value drops below the loan amount, the economic dynamic flips. The client might not have an incentive to top up the account.
Which is why the operational reflexes are just as important as the legal contracts. The system must be capable of calculating the shortfall and executing the margin call before the buffer disappears.
And this leads us to the stress test. Let's say the market experiences a severe downturn. The buffer is shrinking rapidly, and the client hasn't met the margin call. The lender has to act and seize the assets. What does that actually look like?
Well, for enforcement, we look closely at Article 11 of the 2005 law. This article is central because it outlines specific rapid enforcement options. Under this framework, unless the contract says otherwise, the lender does not need a court order to enforce the pledge.
That speed seems vital, but how is it executed mechanically? One of the options under Article 11 is appropriation right. Does the bank simply transfer the assets to its own balance sheet?
Operationally, the transfer can be very swift. But legally, appropriation requires the assets to be taken at a fair valuation. And this is where it requires immense precision.
I can imagine. If you appropriate a volatile asset during a market stress event, determining its fair value at that exact moment must be quite complex.
It is. If the valuation methodology isn't strictly defined and fair, It could lead to disputes. So the valuation mechanics have to be explicitly agreed upon in the documentation well in advance.
And what if appropriation isn't suitable?
Article 11 provides several other avenues. The lender can proceed with an assignment by private sale, or sell the assets on a regulated trading venue, or even through a public auction.
There are also specific routes for certain types of assets, aren't there?
Yes, like the specific redemption of pledged investment fund units. The law provides a versatile menu of enforcement options to suit the asset class and the market conditions.
Let's touch on Article 18 as well, because the sources highlight it as a key pillar for institutional confidence. What does Article 18 do?
Article 18 is crucial because it protects the validity and enforceability of netting. Netting is the process of aggregating the various exposures between the bank and the client into a single net balance.
Okay, so why is that important during a crisis?
Well, if a client enters insolvency proceedings, typically a freeze is placed on their assets globally. Liquidators might try to selectively enforce contracts. Article 18 ensures that the bank's right to net those obligations remains valid, entirely bypassing the standard insolvency freeze.
Oh, wow. So the collateral arrangement holds strong even during a winding up proceeding.
Exactly. It provides exceptional legal certainty.
So looking at the broader context of the market today, our sources indicate there are no new legislative overhauls on the horizon. The law is very stable. So what are practitioners actually focusing on right now?
The primary focus across the market is purely on execution. The rules are established. The task now is ensuring flawless operational readiness.
It makes me think of enforcement as a bit of a synchronization puzzle. You could call it the three-document problem. To safely enforce a pledge, you need 3 separate agreements perfectly aligned.
Right. You have the credit agreement setting the loan terms, the pledge agreement establishing the security right, and the custodian arrangement dictating the operational rules.
And if they don't perfectly align,
then you have a problem. The most elegant legal pledge will face difficulties if the margin call timeline in the credit agreement contradicts the processing windows built into the custodian's IT system.
Right. If the credit agreement gives the client 2 days to cure a shortfall, but the custodian system requires 3 days to process a transfer, the mechanics are fundamentally mismatched.
Exactly. The commercial goal is to provide a flexible credit facility for the client, but the legal and operational task requires unyielding precision. You cannot wait for a stress event to test these mechanisms.
You definitely don't want to be figuring out the IT protocols while the market is dropping.
No, you don't. A highly functional secured credit line requires preemptive alignment. The lender confirms the account location, perfects the pledge using one of the 4 methods, and rigorously tests that the enforcement workflows match the legal timelines.
It's really a fusion of different disciplines. The legal team, risk management, and the operations departments all have to be completely synchronized.
And that synergy is precisely why the Luxembourg framework is so highly regarded internationally. It isn't just a set of legal restrictions, it's a very practical operating system that offers contractual flexibility and highly reliable enforcement tools.
So to summarize what we've covered, a Lombard loan is only as robust as the operational control supporting it. Legal claims are important, but you need that digital control over the account.
Yes. And under the Luxembourg framework, the account location is paramount. The conflict rule ensures that the jurisdiction where the account is maintained governs perfection and enforcement.
And finally, that alignment is everything. Resolving the 3-document problem before any market volatility occurs is essential. Ultimately, Luxembourg's highly refined regulatory environment continues to serve as an exceptionally stable and strategic pillar for global financial operations.
It provides the clinical precision that modern cross-border wealth management absolutely requires.
Which leaves you with an interesting thought to explore on your own. We've spent this time discussing how the strict rules of account location dictate security. It really makes you consider how much of our borderless digital financial system still fundamentally relies on the legal concept of physical geography to maintain stability and trust.
It is a fascinating balance between digital assets and traditional legal boundaries.
Definitely something to ponder. Thank you for exploring the Luxembourg Lombard lending framework with us. Follow on Apple Podcasts, Spotify, or wherever you get your podcasts. Subscribe to Bertrand Mariaux and Rigore Media on YouTube. Connect with Bertrand on LinkedIn at bertrandmariaux.com. All links in the show notes. This was the Luxembourg Fundcast.